Well, the topic we're up to now is pensions, and I'll be covering pensions over several days. And I really don't think pensions are difficult if you constantly focus on the liability issue of it. We talk about many different accounts with this, and we do something called walk forwards. So there's a lot to it, and that's why I've decided to kind of divide it into sections, and then within those sections to think about, do we understand these concepts? Can we apply these concepts? And then move on to another concept. But overriding, the reason why we are discussing this, and you can't forget the big picture. The big picture is that intermediate 2 is about liabilities and equity. And we're talking about pensions. We're talking about a fairly large liability issue for most corporations. Most corporations and universities have these retirement accounts. There is a little bit of a difference here because when you're talking about a university, it could be a state-run university. In that case, we have state laws that protect people, that protect the retirement accounts. When you get into corporations, you don't have those same protections. And often when we talk about the retirement accounts in corporations, and one corporation acquires another or dissolves a corporation, then the thing that gets raided is the retirement accounts. It's a sad thing that happens, but it happens. With a university or a state-run or federal-run institution, you have some protections. Individuals contribute to their accounts, these retirement accounts, through their payroll deductions, and employers can match these, and oftentimes they do match the contributions. There are two separate kinds of accounts, retirement accounts, plans, and these retirement plans differ greatly, and it causes our accounting to differ greatly. If you have fixed contribution plans, these are called defined contribution plans, then you fix the amount of pay which is going in, or the contributions going in. Could be 5% of pay, for example. It could be a voluntary type plan, or it could be a plan where the employer requires an amount to go in. And then the employer can match it or not match it. These are defined contributions, and the way I think about this is defined, I would use a word as set. There is an amount that goes in, and there is a way to calculate the amount which goes in. In terms of algebra, when we say defined or when we say set, we can think of a number. We can think of a number, and we could calculate that number. Defined benefit plans, on the other hand, we are talking about what the employee will get out of the plan at a future date. So you can either talk about setting the amount which is going in, or you can be talking about setting the amount which goes out. And the amount which goes out is going to go out at some future time period in which that particular employee is going to retire. So if you talk about a fixed contribution or defined contribution plan, you're talking about funding of a plan, and you're talking about the responsibility to put the funds into the plan. When you're talking about a defined benefit plan, you're talking about your responsibility being to pay amounts to an employee, in the future. When you talk about a defined benefit plan, you might think of this as something like Social Security, because you have amounts which are going out in the future. There are amounts which are going out at some future point to individuals when they retire. So this creates a number of issues for us, the issues differ, and so the accounting for those has to be different. Pension plans are separate from a company. They are kind of separate entities, if you want to look at it that way, because they are managed separately from the company. The payments flow from the company, out of the company, into the plan or the trust. And then the trust will give out the benefits. The person who is in there that is managing all this is going to be the trustee. The company does have some responsibilities here, though, to keep track of those expenses and liabilities. When we're talking about a defined benefit plan, the effects of that will show up in the company's balance sheet and income statement. And when you're talking about a defined contribution plan, it's going to show up also in the company's balance sheet and income statement. We'll get into this later. The point we want to make now is that it is so comprehensive that you have a separate entity that is going to manage things. It's going to manage and account for the pension plan. So there's a number of learning objectives. This is again why I've decided to divide the whole thing into days. And I cover 1 through 3 in this discussion, which is day 1, and I will continue learning objective 3 into day 2. So our main concerns are up here for 1, 2, and 3. And we have briefly already described the different retirement plans, but we have not got into the accounting for it. We'll get into that today, which is going to lead us into PBO, which is projected benefit obligation. I will be saying PBO. PBO means a liability. And we're going to talk about how this liability changes its value today. We're going to talk about service years. We're going to talk about present value calculations and how that affects the balance. And then we're going to start talking a little bit about other things that can change the balance. And that discussion also carries us on into day 2. The 2 primary plans then are defined contribution. This is where you set the amount going in. It can be contributed by the employees or the employer. There are no guaranteed benefits going out. And generally with these, the employee gets to decide how the funds are going to be invested. The return will be based upon the investment choices which were made. You can think of this as putting money into, say, a stock market and then at some point taking the money out. The employees get to make a number of decisions with it, and therefore they bear the risk. The contributions are set, but the benefits are not set. And so the employee has to take some active responsibilities. As far as accounting for this, where's the liability? The liability has to do with the amount that's going into it, and this is based upon some particular rules that may vary from year to year. But once the amounts that are required to be put in there are put in there, that is the extent of the real liability that exists for the company. So as long as it's funded, there's no liability. You know, it's all paid. However, if it's not funded, there is a liability according to the amounts that should have been put in there. Defined benefits plan, the responsibility here is going to pass to the employer. And as a second bullet point notes, the risks are the employer's risks. The risk that the individual lives longer than is expected to live, and therefore they are going to continue to work for the company for a longer period of time. And I'll get into this more later because we're not talking really about one individual, we're talking about all the individuals, and we're talking about the life expectancy of all our employees. The employee may decide to stay with us. And again, let's look at all the employees. If an employee leaves the company, then they're not going to accrue these benefits because they're not going to continue with the employment. So there is attrition changes, there's the risk about the life expectancy, and then also the employer is going to be guaranteeing benefits to the employees. So if we make bad investment choices, and we are going to be making those investment choices, then we are still going to have to come up with the funds at the end. So with these defined benefits, the trust is going to invest funds, they're going to earn a return, and then they're going to pay a certain amount to the employee according to some formulas. There's so much risks with defined benefit plans to the company that the company cannot control, that a lot of corporations try to get away from defined benefit plans. They'd rather just have defined contributions. They like to put the money aside and be done with it and not have to actively manage the trust. So there's obviously, from the standpoint of a corporation, we would rather have one. However, if you're an employee, you might like two, because with two, you don't have to think about what's happening with the stock market or how to invest those funds. Someone else is doing it for you. Different folks will like different options here. So there are the two plans, and you can see that when we're talking about liabilities, they're going to be quite different. When we have a defined contribution plan, the accounting for it is very simple. We simply set the money aside. So we take cash out and we put it in, and we call it pension expense. And once we have put the funds aside, that's the end of it. It's up to the individual employee to manage those funds once they are in set accounts. We'll call it accounts loosely. So in the first instance over here on the left, we pay $62,000 when we're only obliged to pay $60,000 in for this time period. We have overpaid, we have overfunded. In the second case, we actually underfund, and this would create a liability. We tend to refer to this pension payable here as a current liability and not a long-term liability. The thinking here is that it will be paid, and it may be just a timing issue. Maybe the company doesn't quite have enough cash today, but we're going to pay it. We're going to pay the extra $1,000, and it will be taken care of. Again, this cash that's paid is going to be paid into a trust. And so it's going to go into a trust, and it's under this defined contribution plan, the employee has to manage their own trust. They're the managers of their own trust, so to speak. Now, we are going to have a defined contribution plan here. On December 31st, the company contributes $30,000 to a defined contribution pension plan. The contribution plan required by the formula is $45,000. What's the effect on current assets and current liabilities? Under something like this, do your journal entry. You figure there's $30,000. Apologize for this accounts, this pension payable. It should be obviously a credit over here. Sometimes when I create the PowerPoints, things don't copy over right. You see here we have several current accounts. We have the cash account of $30,000. We have the pension payable of $15,000. So the pension payable is a current liability, going to go up by $15,000, and cash is going to go down by $30,000. It's discussed down there below. What is true about a defined benefits pension plan? A defined benefit plan defines the amount of cash that an employer must deposit to fulfill its pension obligation. What we say about this is defined benefits means set benefits. So either we're going to be setting the benefits or we're going to be setting the contribution. If we set the benefits, then you have to think about what are the two plans and what are the differences. I believe when we look at one, it says defines the amount of cash. It doesn't define the contribution. This is not a defined contribution plan. No investment risk is borne by the employer. No, the employer is actually bearing all the risk. At the end of a reporting period, an employer can measure exactly the total amount of pension benefits that is responsible for employees in the future. And I think that the key here is it says measure exactly. Measure exactly. And what I want you to start thinking about with all of this is that when we think about this, we have really a lot of estimates going on. The benefits to be paid to employees depend on events that are beyond the employer's control. I really think that D is the right one. C is almost right, except it says can measure exactly. And at any point in time, we can't measure exactly because we have actuarial risk. And that is the risk that we do not actually know all the events that will actually happen. We don't know the life expectancies exactly of our employees. And when we get into it, you'll also see a lot of times it's based upon not only the years of service, but their final salary before they retire. How can we determine that? Today, here is an example for us. It's going to take me a little time to get through this one. What I would suggest, though, is that you think about a timeline, and maybe you want to print out this particular slide and look at it, and then also look at how I explain it, the way the problem is worked. We're also going to have a problem in the packet that's very similar to this, so you'll get another time through this problem. This is how we would create or calculate a liability based on one employee. And I want you again to back up and think about defined benefit plans in terms of many employees. So this is just one employee. An employee retires after 30 years of service with a final salary of $100,000. The annual benefits are going to be 1.5% times 30 years times their final salary. So what you would do is think about it first. Is this a defined benefit plan or a defined contribution? It's a defined benefit because you're going to say up here the annual benefits are set according to some formula. What are the amounts of benefits the employee would get? The employee is going to get $100,000 times 1.5% of that times 30 years. So that comes out to $45,000 annually that the employee is going to be receiving. The projected benefit obligation, I call it a PBO, reflects then the present value of the payment streams as of the balance sheet date. So to figure out how much this PBO should be, you are going to have to think about several flows. First of all, you're going to think about an annuity, which is going to be happening $45,000 for each year. Take the present value of that back to the date of retirement. Then you're also going to take the present value of that value back to today's date. So what does the company have to do to prepare for this? They have to put the money in investments that earn enough interest, enough returns so that they're going to have that value available to pay out this $45,000. When do we think this employee is going to retire? Because that's going to be a consideration there as well. And what will the salary be when they retire? Because we have a salary calculation up here, and we're projecting $100,000. The defined benefit plan accounting is very complicated because we have the PBO, we have the fair value of the plan assets, we have an income statement item called pension expense, and we have another income statement item which is called compensation expense. And we have something which we will get into later, which is an OCI amount. The PBO is a present value calculation done by an actuary based on the employee's service at a given date. And usually this is a balance sheet date. Present value is a time value of money calculation, and the actuary has to take into account the estimate of death, the withdrawal from the plan, how their compensation might change, all kinds of factors. The trustee is going to invest the plan assets, and the investment then is going to increase with the returns, and you're going to be using present value, fair value accounting here when you're talking about plan assets, because you're going to value everything at its fair value. There's going to be cash, but the fair value of cash is cash, just that value. However, investments, their value is going to change. If it's a return, which is actually return earned, which is in cash, say dividends, that gets included in cash. However, if it's a value of the investment that goes up, then you see that return showing up as the value of the investment increasing. Benefits are going to be paid out. When the benefits get paid out, your cash goes down, and this will decrease your plan assets. Let's do that calculation then. We have Jessica Farrell, who was hired in 2005. This is where I think you need to do the timeline. And they're going to calculate the amount of annual benefits. This is the annuity that this Jessica Farrell will be earning once she retires. 1.5% times the number of years she's worked for the company times her salary. This is the final year's salary. She's expected to retire in 2044 after 40 years, and she's going to expect to have a retirement period of 20 years. At the end of 2014, 10 years after being hired, her salary is going to be $100,000. This is an actuarial estimate. A lot of this is the actuarial estimates because we don't really know. She may decide to leave the company and not continue working, in which her service years aren't going to be 40. There are a lot of changes that can take place here. The interest rate we're going to think about is 6%, and that's the 6% we need to use when we're going to do our present value calculations. So what is the company's PBO obligation as of today? Well, the steps you need to take here is first to use the pension formula and figure out how much you think she is going to earn in terms of an annuity. I calculate this as being $60,000, 1.5 times 10 times 400,000. This is to date because you're going to use to date service years up there, and it's going to be 10 years. So you're going to look at that and you're going to say, well, at the end of 2014, 10 years after being hired, you're going to say, well, she was hired in 2005. So 2005 from 2014 does not give me 10. Well, it's the end of 2014. She was hired at the beginning of 2005. Therefore, you really have an additional year in there, and that's how you get the 10. Instead of 9, the difference between 2014 and 2005, it is actually 10. Now, this gets us to $60,000, the annuity. At the time of a retirement, how much will the benefits be, the present value of that annuity? So you have to take the present value of the annuity, and this is for 20 years, 6%, and it's going to be $60,000. And you get a value at the time of retirement of $688,195. But that's not the relevant thing. We want to know what the liability is as of our balance sheet date. So that is the present value of one of $688,195, which today's value of the PBO for this one employee is $119,822. So I suggest you just take some time and work through it. Now, What happens if the employee works another year? What happens to the PBO? Well, you're 1 year closer to retirement. So when you do your calculation, you're not going to think about this as being the full amount. It's 1 year less than that from where we were last year. And you're also going to think about this in terms of the periods. The number of periods will change, and that is calculated and it has an effect on the interest. The other thing is the employee has worked another year, so they have another service year in there. We call this service cost. The fact that the employee has worked another year and will get additional benefits from having worked that additional year. This is the chart that I was referring to then. In 2005, in 2014, it's 11 because you're going to assume that in 2005, this is the beginning of 2005. This is not the beginning of 2014, but the end of 2014 when we are doing our financials. This is then 11 years of service. So in the instance here, then you're talking about the difference between this period and here. If you move this out a period, then you see what actually happens is the service, the years into retirement change. So you have 29 years in your present value calculation here, but you have to really start back here. And you think about this and you figure out this annuity amount has been changed, and the change in the annuity has to do with the number of service years having changed, and you will project the new service year into the amount of the annuity which is being earned. And so when you do your present value calculation, you come up with an amount which goes back to this date. When you go back to this date, this time period will change, and it will change because, again, another year of service has been added. So there's one more service year which is included in our calculation, and the employee is 1 year closer to retirement. We can then say that the PBO at the beginning when we started was this amount, but there are two factors that are affecting the amount of our PBO at the end of this new year, and that one amount is coming about because there's another year of service that's been put in there. And the other thing that changes is you are calculating, I hesitate to call it a return, but you're calculating interest on the beginning balance. And this is 6%. Okay, so the liability is going to increase over time because of the time value of money. So this interest cost, I'm calling it interest cost, it is really a time value of money calculation, and it's based on beginning balance. So beginning balance calculation increase. Okay, so now the next thing for us to do here is to start working in our package.